Today, we are speaking about mortgage options, particularly those options that are available to first time buyers. What can they expect and how to best prepare? My guest on today's episode is Michael Dorego. Michael Dorego is a mortgage agent, a mortgage specialist with Northwood Mortgages Limited. Before he joins the podcast, I want to introduce the different types of mortgage options. Reverse mortgage, we'll be speaking about reverse mortgages as well as reverse mortgage myths and facts, down payment assistance, the various programs that are available to first time buyers, and our borrow. Our borrow is a tool that buyers can avail themselves of, which is a unique proposition and can be an ideal situation for those that don't have the full down payment. Welcome to another episode of Brick by Brick, Building Wealth Through Real Estate. My name is Nico James Bach. I am a broker with Royal LePage Signature Realty. As I mentioned, the guest on today's episode is Michael Dorego. We are going to We're going to welcome Michael as he joins the podcast.
Hey, Nico, how are you?
I'm well, thank you. How are you doing?
Good, thank you.
There you are.
There you go.
I made an introduction, a brief introduction. So the listeners and those watching the video now know that my special guest is none other than Michael Dorego with Northwood Mortgage Limited. Michael, how about you present yourself and then we can get started with the episode.
Sure. Great to see you, Nico. Yeah, so Mike
Likewise.
Dorego with Northwood Mortgage. I've been a mortgage agent now for the past 8 years, always with Northwood Mortgage. Other than that, I'm married with two kids and, busy lifestyle having two young kids, right? They're both under
Uh,
10, so you can
yes.
imagine how busy.
Yes. So I'm sure
But
you are very, very busy. A lot of changes in
yes,
the mortgage world. So we can get to those immediately. I will give you, are you able to see the screen?
I can, yes.
Okay. All right. So I guess in my introduction, I mentioned reverse mortgages, the mortgage stress test, down payment assistance, the various options available to first-time buyers, as well as the mortgage rules that have changed. There were new rules that were introduced on the 15th of December of 2024. So let's start with reverse mortgages, facts, myths, some insider, I guess, tips that you could share. Let's start with that.
Sure. So before I was a mortgage agent, I was actually very much anti-reverse mortgages. I just heard a lot of bad things about them. I think there's a general stigma. What I realized was a lot of the misinformation I had came from the US version of reverse mortgages, primarily the ones that were done prior to 2008. In fact, in the US, at one point, you can get a reverse mortgage up to 95% of your home's value.
Oh, wow.
Imagine if the market just dropped 5%, you essentially have no more equity in the house, right? So,
Correct.
fortunately for Canada, reverse mortgages are very restrictive. And when I say restrictive, is that they're very heavily regulated, rather. And so in Canada, generally speaking, the most you're able to borrow on a reverse mortgage is 55% or so of your home's value.
Okay.
and you have to be advanced in your age for that to happen. So a 55-year-old, for example, could not get 55% of the home's value, be closer to 30 or 40-ish. The reason for that is the reverse mortgage company, they really want the homeowners to have a lot of equity in their house,
I see.
right? So there's a lot of restrictions in place. Um, so again, that's the main thing there with the reverse mortgages, a lot of misinformation. So one of the one of the myths is that you don't own the property, the bank or reverse mortgage company does. That's actually not correct. The homeowners are always the owners of the property. That property is theirs until they sell the home or they both pass away,
Okay.
right? So even if one person passes away, the person who's still alive gets to live there as long as they want to. The only time there may be an issue is if the property tax is not being paid, if the property is not being properly kept up. But
So they basically have to take care of the property
of
as
course, yeah.
usual,
Of course, yeah,
keep up
because
its value.
the mortgage company, they have just as much interest in the equity as you do, right?
Right.
Ultimately, they want to get paid back eventually. Um, the good thing is you can never owe more than the house is worth. That is a guarantee across the board. So if somehow you owe $1 million on a reverse and the home is worth $1 million, even less, the home is worth 900,000, for example, you can never owe more than the house is worth. It's
Okay.
called a negative equity guarantee. That's the beauty there. So yeah, you are the owner of the home. It's only due, the money is due upon sale, as I mentioned, and the death of both or any home borrowers essentially,
Okay.
right? Another myth is that you got to be in a desperate situation to get one. And the reality is it's not the case because a lot of people who retired, they have investment for portfolios that they're taking money from. But the cost of living's gone up, right? As
Right.
everyone knows, everything's more expensive.
Right.
And what happens is a lot of times, people are having to increase, the withdrawals from their pensions, you know,
Correct.
RIFs, that kind of stuff, TFSAs, just to make ends meet. And the reality is a lot of seniors, people are retiring with mortgages still and a lot of debt. I'm telling you, I've seen people, Nico, 65 plus
Right.
with hundreds of thousands of dollars in mortgages and tons of consumer debt. And it's eating up most of their income, right?
Right.
So
Right.
so instead of taking out more money from your investment plans and depleting the money very quickly, what you can do with the reverse mortgage is you can actually pay off your entire mortgage, pay off all your debt, and go from, for example, having a $3,000 a month debt payment down to zero in like 60 days or less,
Right.
right? So
Yes.
if you no longer have, three, four, 5,000 a month in debt payments, in theory, you could start taking less money from your investment plan and have that money last longer because you're not having to withdraw from it as quickly,
Right.
right?
Okay.
And that's one of my favorite methods for the reverse mortgage is just paying off your mortgage and essentially living mortgage free in a sense, not having any payments, right?
Okay.
Another reason people use the reverse mortgage too is they're not desperate financially, but they have an adult children who maybe have good credit, good income, whatever it is, but they're having a hard time buying their first home because they don't have enough down payments.
Right.
And the reality is people are living longer nowadays.
Yes.
So someone can be 70 and their adult child is maybe 50 in their 40s and they have never bought a home yet. What the homeowner can do or the parent can do is they can actually give a living inheritance while they're alive, basically giving their children the down payment to buy their first house.
And they would get that through a reverse mortgage.
Exactly. And the beauty there is there's no monthly payments for that, right? So
Mhm.
so the homeowner is not taking on a monthly payment. The adult child is not having to pay for that money.
Mhm.
It's and a good thing too is that the homeowner, like the parents, they can actually watch their children buy their first home. They can watch their grandchildren grow up in the house. And you're basically you're getting to you're seeing your legacy live out while you're alive. You're seeing it
While you're
happen
alive,
in real
which is a
time, right?
huge advantage for a lot of
Exactly.
seniors. A huge
Exactly. And then
advantage.
and I call it giving with a warm hand versus a cold hand. You're still
Right.
alive doing it, right?
Yes. Yes.
And then one of the gripes that some people have with reverse mortgages is that yes, when you pass on, you're going to leave potentially less equity for your children as inheritance. But if your children are buying their own homes, you know, they're going to build up equity in their own house. So
Correct.
you kind
With
of
money that
wash
you've provided.
exactly, right? So that's how I look at it. Again, no one has to do it, but it's an option, right?
Okay.
Um, another myth is, you know, just that you can lose your home and you know be forced out of the property again. If you pay your property tax, you maintain the home, the property is always yours. There's no issues there. Now, one of the cool things about reverse mortgages is that you're also able to pay down some of the interest if you want to. So, for example, let's just say for simple math, the monthly interest on a reverse mortgage will be about 2,000 a month, let's just say.
Okay.
That, so again, because there's no payments, you're not paying anything. What's happening is the reverse mortgage company is taking the interest and adding it to the balance. So whereas
Ah,
a
okay.
normal mortgage, the mortgage goes down,
Right.
this one goes up because it's going in the reverse way. But for example, let's say a couple, we do a reverse mortgage for them, they're paying 3,000 a month before for their bills. Now they're paying zero. They have 3,000 bucks a month in their pocket. If they wanted to take 1,000 of it and put it towards the interest, they could, and they can minimize the appreciation of the interest drastically by prepaying it and then still maintaining 3,000 a month cash flow in their pocket. So they
Ah,
kill two
okay.
birds with one stone. Is you have more money in your pocket and you can take
Right.
some savings and also pay down some of the interest should you choose to. Again, it's not mandatory, but the option is there, of course.
Okay. What is the qualification process like for reverse mortgages? Like, what's the procedure, just in a nutshell?
That's a great question. So there's four companies that do reverse mortgages in Canada, four main ones. There was a time where there was one.
Oh,
Um, and the beauty is that now because there's more now, there's more option and there's more competition, which is good for consumers, right? So they have more options now than ever. Now, um, every single mortgage company has its pros and cons, right?
right.
So some will lend more than others. Some may have a higher interest rate than others. Some will lend in certain areas, some won't. So there's a lot to take in there.
Okay.
Most of them, three of the four, they will only give you a reverse mortgage if you're age 55 or more.
Okay.
But there is one that will do a reverse mortgage for someone of any age.
Oh, really?
You just have to have a decent credit score in the 600s. I believe it's 660. So
Okay.
any age up to about 43% of the home's value. So
Okay.
there is pretty much options now for everybody. So again, decent credit score doesn't have to be stellar. It has to be on an owner occupied home, so it cannot be on a rental property. You have to live in the property. And generally speaking, for income, you just have to make enough to really just cover your property tax and your utility bills. So you don't have to have a very high income, which would make sense because most retirees who are just living off pension, like you know, CP and old age security, they're not making more than sometimes 30,000 a year.
Right.
So they're not very restrictive. Whereas with a line of credit, for example, from a bank, a line of credit, you have to make enough income to qualify for it. And the problem with line of credit is that once you start drawing from it to pay your bills, let's just say, well, now you have a monthly payment every month to pay for, right? So what happens is when you draw up the line of credit high enough, that minimum payment is eventually going to get very high, and now you're back in the cycle of oh, darn, now we got more monthly payments again,
Right.
and the cycle continues.
Okay.
Right? So
Excellent.
nothing to consider because there are four companies, they're all going to toot their own horn, right?
Right.
Every reverse mortgage company is going to say that they're the best ones to work with.
I know.
What I do as a what I do as a mortgage agent is I actually listen. I find out from the clients, okay, what are your goals? You know, how long do you plan on living in the home for? Where do you live? How much do you need? Once I get all that information, what I then do is I then compare each of the four companies to find out which one makes the most sense for that family, right? So again, sometimes if you need a high amount, you know, one company is going to give you the most. That's the one you need, right?
Right.
Sometimes if you need less, now we can be more competitive on picking which one is going to give you the better rates, right? So the
Okay.
good thing is I get paid by the company directly, so I don't charge for my services.
Okay.
So it's free to use. So if anyone is looking into reverse mortgage, I have a lot of experience in them. I can explain the pros and cons of each one and then help them choose which one makes the most sense for them, walk them through the whole process, and they don't have to pay me a dollar for that services at all.
Excellent. Good to know. We can move on to another option, which is down payment assistance for first-time buyers and also for other buyers that qualify, depending on the product. This is also another avenue that should be explored for those who want to buy property. Can you give us a rundown of the first option, which is Our Borrow, a co-ownership program designed to assist home buyers by contributing to their down payment in exchange for a share in the home's future appreciation?
Yes, yeah. So what I like in Arboro too is kind of like the show Dragon's Den or Shark Tank.
Hmm.
What you're doing is you're essentially going into home ownership with this company, and they're going to provide some of the down payment, help you buy the property in a share for some of the appreciation of the home.
Okay.
So essentially, what Arboro does is they will pitch in up to 15% to help someone buy their house.
Okay.
Doesn't have to be their first home, but it has to be their only home. Can't use it
Okay.
for rental. It's got to be something you're going to move into yourself.
It can't be for an investment. It has to be
Not at
something.
all. No,
Okay.
they want someone to live there and take care of their property themselves.
All right.
Especially what the company thought was, instead of us buying rental properties and having tenants and maintaining the properties, why don't we just help other people buy their first home? Because generally speaking, a homeowner tends to take care of their property better than a tenant, only because
Yes.
it's their own house, right?
Yes.
So
Yes.
have a homeowner live there. They will take care of the maintenance of the property. They get to live there, build up equity, and then we'll share in some of that growth with them. So the minimum the homeowners have to have is just 5% plus
Okay.
closing costs. Closing
Okay.
costs, I recommend having about 3% of the purchase price set aside. And so essentially, you put down minimum 5%, Arbor puts it up to 15. So now you
Okay.
have a 20% down payment.
Okay.
20% down completely changes how much someone can qualify for on a purchase. It's actually mind blowing. I'll show you in a second after what that does.
Okay.
Um, Again, Arbor is a silent partner. What they do is to break it down in a nutshell is let's just use a 50-50 split. So for example, the buyers put down 10%, Arbor puts down 10%. 10% of the buyer's money equates to 50% of the total down payments, 50-50.
Hmm.
So what will happen is let's assume the home goes up in value by $100,000.
Hmm.
Our borrow would be entitled to 50% of that, which is 50,000, and the homeowners get the other 50%, which is 50,000.
Okay.
So it's an equal split on the appreciation. Now, when you have a mortgage, Nico, as you know, the mortgage gets paid down, right?
Yes.
So the principal pay down of the mortgage, all of that is kept by the homeowners. So if they
Ah,
pay the mortgage down by 100,000,
right.
that 100,000 is all theirs. And if
Okay.
it goes up by 100,000, that 50,000 is theirs. So they walk away with 150. Now they have two options: is they can sell the property, take the proceeds, like take their equity out, and then buy their next home. And at that point, they shouldn't need our borrow. You can buy that place on your own, or they can refinance and pay back our borrower their share, and then they can retain all the equity going forward. Now, to refinance, the property has to go up in value enough because you can only borrow up to 80% of the home's value.
Okay.
So it is possible, but I generally tell people you're probably better off just selling and then moving up after. That's
Yes.
generally the better idea.
Yeah.
Now, to give you an example of the difference in numbers, if a couple or a household is making 150,000 a year, okay,
Hmm.
and they have no debt whatsoever, which that's almost impossible nowadays, but no debt
Yes.
whatsoever, and they
Okay.
have 100,000 for down payment. They have money for closing costs, but they have 100,000 earmarked for down payment. They would need with 100,000 down at they would qualify for a maximum of about 730,000 purchase price. So they could find a home, they could buy a home for about 730.
Okay.
And this is because it's based on insurance guidelines. So when you have less than 20% down, you have to have an insured mortgage.
Hmm.
And the qualifications are very stringent. You have to basically your income cannot be like your mortgage payments and debts and whatever else cannot be more than a certain percentage of your income. And
Okay.
that's where about 730 is the max. Now with our borrow, if they were to put down 100, for example, they could buy a home for 900,000 instead, with their 100,000 down.
Hmm.
And so the down payment on 900 is 180. So they're putting in 100,000 of the 180, which means that they would keep 55% of the equity appreciation,
Okay.
right? And
Yeah.
I mean, Nico, you're a realtor. If you look at a certain city or town and you compare homes that are worth 730 versus 900,000, how
Yes.
much nicer are the homes probably at 900,000 versus 730?
Well, it would vary depending on the city,
Of
obviously, but
course.
generally much nicer.
Yeah, better locations, probably more options.
Yes.
There's probably some cities where you might not even be able to find a home at the price you qualify for, right? So
Correct.
So
Correct.
the idea is, yeah, just basically to give them more options. So again, you do need about 3% for the closing costs. Our borrow, they will actually cover the proportion of land transfer tax according to what they're putting in. So for example, if they're putting in 50% of the down payment, they'll cover 50% of the land transfer taxes. And because there's 20% down, there's absolutely no insurance premiums whatsoever. So that's
Okay.
roughly an average about $30,000 just in savings alone, because you're putting down 20%. You wipe out the insurance premiums, and then you also get a reduction on the land transfer tax. Now,
Okay.
what are the catches? Well, there's going to be a bit of a lender fee on the mortgage amount, about 1%.
Okay.
Mortgage broker may charge a bit of a fee to arrange the mortgage,
All
and then
right.
you have lawyers and stuff like that. And that's where I say have about 3%. That's usually enough to kind of cover everything,
Ah, I see.
and
It's
then
for
basically
all
give
the
you
other
backup.
players that are involved in arranging the
Exactly.
arbor. Okay. Okay.
Exactly. Now, the minimum purchase price of the Arbor is 550. So you have to qualify for minimum 550, and you have to buy in the designated regions that they cover. So
All
on their
right.
website, it shows you where they allow you to buy
Which
a
regions?
property.
Okay.
Major cities, Peel
Yeah.
region, GTA, Waterloo region, Guelph area, like Barrie, a lot of the major areas, right?
Okay.
Now again, one of the pretty much the only objection I'll get is, Michael, we want to buy a house, we don't qualify for enough. Our bank said we don't qualify for enough with the down payment we have or the income we have. But our borrower, we're giving up, a good share of the equity, the appreciation rather. Like it's hard to stomach it. And I usually tell them, I totally get where you're coming from. But here's the thing though, you've been renting for 10 years,
Exactly.
you're paying 3,000 a month.
Uh-huh.
How much of that 3,000 a month or rent do you get back after you move? And the answer is zero, right? So I always tell people, if you can own 25% of the appreciation, is that not better than owning, 0% of nothing,
Oh, exactly.
right? So get
Exactly.
something back, because the easiest way to save for down payment, Nico, is actually by owning a property, because it goes up in value. You're paying down the mortgage, right?
And you get that
It's
appreciation.
automatic. It's automatic
I
versus like
know.
you paying rent and then trying to save $1,000 a month every month. Now the thing is too is as house prices go up, the minimum down payment goes up with it. So it's kind of like a moving target. So I tell people use this sometimes to get on the first step of the ladder and build up from there. Now, if someone has good down payment, good income, everything else, then this is not necessary. But it's the idea is just having an extra tool there for you when you need it.
Okay, you mentioned that there are certain limitations in terms of geographical location of where this program can be applied. Does that also hold true for the type of property? For example, can a buyer use this program, the Our Borrow program, for pre-construction, for example, or a different type of property, like different types of property, like a common elements condo, uh, things like that is what I'm asking. Like, are there limitations from that point of view, not just geographic?
Yeah, so generally speaking, it's condos are fine, detached homes are fine.
Hmm.
I don't really find people using this. I don't really think it's going to be a pre-construction type of product because when you do put an offer on a home, our borough, part of the qualifying too is they have to like the property itself. They
I
have to
see.
want to invest in it.
It
So the
has to be
client might
physically
be approved.
existing. So
Exactly.
obviously
Yeah,
in the
yeah,
pre-construction
exactly.
scenario it won't be. Okay, it'll only be on
Correct.
paper.
Yeah. So it's
Okay.
more for like resale homes.
All right.
Someone they, they have to approve the property. You also want to make sure the property doesn't need a lot of renovations. Like it should be a home that's pretty much livable. You don't want to buy like a fixer upper. They do not want the property to need like 10% or more of renovations of the purchase price. Um,
Okay.
so I always recommend to buyers put a 5-day condition of finance because you might be approved for the mortgage, but our borough has to like the property. And another stipulation is they do not want you to overbuy the property as well.
Okay.
You got to make sure you're buying it at the proper market value because again, they want to make sure that there's going to be equity growth there for everyone.
Okay. All right. Fair enough. On the topic of regional
Mhm.
options, you and I have spoken before about the different programs that are available in other regions. Programs that a lot of people are not aware of. I wasn't aware of some of the programs that you mentioned. I have three highlighted here. Can you go through some of the different down payment assistance programs by region?
Sure. So, Nico, you're not the only one. Most realtors do not know this program exists, and neither do clients or buyers. Um, so, different regions have programs where they want to take renters and put them into homes. They want to open up rental units for people because, as you know, there's, generally speaking, there's people have a hard time finding rentals, right?
Right.
So, every region's a bit different, but the rules are almost all the same in a sense where the region themselves will give you either 5 or 10% down to buy a house. Now, within each region, they're going to have some different rules,
Okay.
but in general, you should be renting in that area for at least
Already.
for 6 months to a year, correct?
Okay.
So I'll
Okay.
give you an example. You got someone living in Waterloo region. They've been renting for a year. They're good to go. That's the first box to check off.
Okay.
Then what happens is each region will have a maximum income you can make in order to qualify for the program. So if you're making like 300,000 a year, it's probably not going to be for you. So each region has a maximum income, and then there's a maximum purchase price. So, for example, Waterloo region, it's around 600,000. That's generally going to be enough to get you into starter home, maybe like a townhouse or a condo. The idea is to get you into a starter home, not into your dream house, right?
Okay.
So yeah, maximum income, maximum purchase price. Now, what I do is when I'm working with a buyer couple, is I check to make sure that they qualify for the regional down payment first, and
Right.
also make sure they qualify for a mortgage as well too. Because one of the things, some regions require you to apply ahead of time, and what they need is a mortgage pre-approval, which I would provide if they're pre-approved,
Okay.
or you go to them when you have a live offer on a property. So
Okay.
you go to a certain region, say, hey, I've got an offer on this house, and then they will very quickly verify that you're approved for the down payment. Again, this is a program where you want to have a 5-day condition of financing because
Right.
again,
Which is always a good
there's
idea.
additional things you have to, of course, absolutely.
Yes.
Because
There are no
sometimes, well,
guarantees in terms of
yeah,
financing.
the reality is, you can have a couple or person who's qualified for a mortgage, but then the lender doesn't like the property, and that's why a condition
Yes.
of
A lot of
financing is
people don't get that it's a two-step process. You have to
exactly.
qualify as a borrower, but also the property that you're buying has to qualify. So that is
Exactly.
a hugely important point.
Exactly, right? So now again, the good thing with this program is that the money they're giving for down payment, there's no monthly payments attached to it. So
Ah,
zero monthly payments.
okay.
It's fully forgiven after 20 years. So if you live in the property for 20 years,
Yeah.
you actually don't have to pay anything back. Now, if
Really?
exactly, yeah, nothing. It's basically you have free money as long
Okay.
as you live there for 20 years. Now, most people will not live there for 20 years. Eventually, they're going to want to refinance, maybe take out some money, maybe renovate the house. So if you decide to sell or sell or refinance within 20 years, you just have to pay back the down payment money they gave you. So the
Mm-hmm.
5 or 10% down, which was never
Mm-hmm.
yours to begin with, anyways.
Right.
and then you have to give them 5 or 10% of the appreciation.
Of the
So if the house
appreciation.
goes
Okay.
up by $100,000, you keep, let's say if they give you 5% down, you keep 95,000 and you give
Okay.
them back the 5 grand plus
Okay.
the down
Plus
payment.
the
So
down payment.
it's probably like the cheapest way to borrow money because the down payment was
Ah,
yours to begin with.
yes.
You're really just paying on the appreciation 5 or 10%,
Okay.
right?
All right.
So really great way to get in. Um, Again, every region is different. So I usually try to find out, okay, where do you live now? And then where are you looking to move to? And then what I do is I reach out to the city, get all the updated numbers because they do change. The prices do go up sometimes every year. The income qualifications go up as well. Sometimes regions are out of money. So right now, Guelph and Wellington County is currently out of money. So
Mm-hmm.
that's where my job is to touch base with them, see where they're at with everything, and then walk the home buyers through the process.
Okay. You
So
had
either,
provided, yeah, go ahead.
yeah, and then the only thing you have to have for this program is just the money for the closing costs.
All
So they
right.
give you a down payment. The closing cost, it's only 1.5% of the purchase price.
Mm-hmm.
So for example, if you're looking to buy a property for 500,000, you only have to have 1.5%, which is $7,500. That's about like 2 to 3 months rent nowadays, right? So I say if you
Okay.
have about 3 months worth of rent, you have enough for closing costs. So really, if you think about it, if you qualify for this program, you can buy a house with just 7,500 down, which is kind of unbelievable if you think about it, right?
Okay.
So both programs have their pros and cons. With the regional program, you have to have good credit because it's an insured mortgage.
Right.
With Arboro, you can actually have a lower credit score and still qualify
And
for
still
that.
qualify.
Yeah.
Okay. That's
And
good to
again,
know.
Arboro, you have to have your 5% down at least. With the
Right.
regional, you can have 1.5% down.
Okay.
Yeah,
Okay.
big difference there.
And just as a point of reference, I guess, with some of these down payment assistance programs, they are only for first-time buyers, correct? Like those that are going
So
from a rental or a home family situation and being a first-time buyer?
so you don't have to be a first time buyer. In
No,
fact,
it
with
could be
both of
any.
them, you just can't be a homeowner right now. So you keep as so if you're renting, for example,
Yeah,
um, uh, Arboro, you can use Arboro because you're looking to buy a home to live in.
right.
With the regional, same thing. You should be a renter. Now, if you're living in your parents' basement
Yeah,
and you're going to move out,
yeah.
the basement is a separate contained unit that they could rent out. That's okay. You're considered a renter.
Okay.
If it's a non-self-contained unit, it's just a regular basement and you happen to be just living down there,
Yeah,
there's no separate entrance, there's no kitchen, nothing.
yeah, yeah.
It's not considered a rental unit. They really want you to open up a
Okay,
rental unit for someone else.
okay. All
That's the
right.
difference. Yeah. So again, you could have owned a house in the past.
Yes,
It's
that's
just
what I
that
wanted
you
to.
don't own one right now. That's the
Right
key.
now.
Yeah.
Okay. Okay.
Yeah.
Excellent. So, speaking of home buying, again, what are some of the hacks that you can recommend or suggest? I have a few on the screen now. And with regards to the down payment assistance programs, as I mentioned before, you and I had spoken before, and you had actually provided me with a list of those regions that do offer these programs. So I'll include that list in the show notes. So, with regards to home buying, some of the hacks, some things that home buyers should be aware of to make it a little bit easier, like to make the process a little bit easier, less
Yeah.
intimidating.
Yeah. So number one way I'd say Nico is marry someone rich, right? So if you,
Yes.
if you, if you can't do that,
If you can't do that,
yeah,
failing
if you do
that,
that,
failing which?
didn't work for me. But so one thing I found that really has helped is you have a lot of like married couples or just couples in general, or even just individuals, and they got good income, they got good credit, but they're just getting priced out just a little bit. Like they've been pre-approved for 750 and they're putting offers in, they're getting beat by 30, 40, 50,000, 60,000. But their mortgage company or bank is saying like you are tapped out at this amount. They don't have more down payment. They're
Hmm.
not getting a raise anytime soon. So the best method I find is this works, by the way, with less than 20% down. So the key, it's got to be an insured mortgage, less than 20% down, is we use what's called a guarantor. Now, what is a guarantor? Um, Essentially, it's somebody that goes on the mortgage with you, but as also as a silent partner. So for example, I always say, hey, you guys, are your parents alive? Either one. Yes, they are. Okay, good. Do they have good credit? Yes. Do they have decent financial? Do they have decent financials? Are they in a lot of debt, or are they mortgage free? What are their finances like? Oh, they're not bad, Mike. My parents both still work. They have a small mortgage, et cetera, et cetera. Okay. Um, what are the odds of them going on the mortgage with you as a co-applicant or a co-borrower? Oh, Mike, I'm not sure they're comfortable because if they go on my mortgage will now go on their credit report. They have some plans to maybe buy a new home, or they want to refinance, and they don't want our mortgage to affect their financing. Well, the
Okay.
beauty is, as a guarantor, um, the buyer's mortgage, like the children's mortgage,
Yeah.
does not go on the parents' credit report at all.
Ah,
It doesn't
okay.
report because they're a
Okay.
guarantor. Now, the,
Okay.
the key is that they do not have any ownership in the home at all, and they do not go on the title or the mortgage whatsoever.
Okay.
They are responsible for the mortgage payments if the buyers do not make the payments.
Okay.
That's the same across the board. But the
Yes.
beauty here is you can use the guarantor's income to help bump up your purchase price. Does that make
Okay.
sense? So I'll give you an
Yes,
example.
it does.
During COVID, I had a young couple. They're recently married. The wife was pregnant. They're having a baby soon, and they were renting. And the rental place was too small. They needed more space. So they were thinking about buying, but the problem was because it was COVID. The husband was a photographer. Business dried up because you couldn't take wedding photos, right? Like,
Right.
who wants a
Right.
wedding photo with a mask on, right?
Yes.
So business slowed down, right? So what happened was they just didn't qualify to buy anything decent that they were looking for to basically help them with what they needed. So what happened was we put her parents on as guarantors, and we're able to bump up the purchase price. And what they did was they very smart. They bought a duplex,
Ah,
and
yes.
they're able to rent out the other unit, and that tenant pretty much pays all the mortgage for them. So they own a place and they're living essentially mortgage payment free. And what could happen is later on, when they do qualify on their own, we could have the guarantor removed if they want to. But the beauty there was when I talked to their parents, they did say, Mike, we would rather really not have their mortgage in our report. And the beauty was that that was the case. It was never going to go on there because they're guarantors, and that's what they liked about the program the most. And what
Excellent.
I
Okay.
do talk to the guarantors myself because I want them to know exactly what's happening, right? They need
Right.
to know the ins and outs, right? So now, as a guarantor, you don't use one to increase your purchase price by 200,000 or more, because it's got to be a reasonable amount, because the insurance company like CMHC or Canada Guarantee or Sagen, they have to also approve it as well, and they
Okay.
want to make sure you're not going way above your means. So this is great because you got people that maybe like have a newer job, they have a bonus coming in but they haven't got it yet, so you cannot use bonus income unless you've had it for 2 years. But I know if they stay there for 2 years, they're now going to have bonus income. So they're going to, be making more money than they are now. Or maybe they got a raise coming up or something. So we know that they're not going too much above their means, and that they should be able to qualify completely on their own within the next 1 to 3 years or so.
Ah,
That's it.
okay. All right.
And
That
bump the
makes
price a
sense.
bit within reason, right? Another house buying hack, we call it, is people want to invest in real estate. They want to buy rental property. The problem is you need 20% down to buy rental property, right? Not everyone has it. So what you could do is you could actually tell the mortgage company that you're going to rent out your current home and then live in the new one instead. And the beauty there is you
Okay.
just have to have the minimum down payment on the new one. So just for example, if you're buying a property for 500,000, the minimum is just 5%, which is 25,000. But if you're
Right.
buying it as a rental, you have to have 20% down,
20%.
which is $100,000,
Right.
right? And then what we do is when we do the mortgage for you, we get what's called a market rent appraisal. So it's an appraisal on your current home, and the appraisal company will determine how much you could rent your house out for, and then basically help you transition from that home into the newer one. Now, the story has to make sense too, because if you're living in a 5,000 square foot house and you're going to say you're going to move into a condo and you're a married couple with 3 kids, they're
Ah,
not going to believe that. So if you're
clearly.
going from a condo into a detached home, for example, or a townhouse, a bigger property, that makes more logical sense. You're moving up
Yes.
and you're going to take the current property and rent it out. So that's a great way to just own a rental property without needing 20% down, for example.
Excellent.
Yeah.
Excellent.
There's
Very
one
helpful.
more. There's
Yeah.
one more I want to talk about. It's self-employed. So you and I are self-employed, Nico. So,
Yeah. Which is also very challenging in order to
it's
get
very
financing.
challenging. The main problem with being self-employed is that the banks, keyword is the banks, they will pretty much qualify you based on your net income. So the income you claim after taxes. Now, what do most business owners do, Nico, is they write
It,
off their income, their
exactly.
expenses, and their income is too low on paper. So what happens is they don't qualify for very much. So the key now is if you have 20% down, 20% or more, of course, as a mortgage agent, we have lenders that will qualify you not based on your net income, but based on your revenue.
Ah, okay.
Imagine if you're a business owner, you're making 500,000 in your revenue, but you're showing 50,000 net. The bank will use 50,000, which is not enough nowadays to buy pretty much anything.
Right.
Our lenders, they will use the 500,000 revenue instead, qualify for a lot more purchasing power. Now, the question is, if you're self-employed and you don't have 20% down, what do? Well, combine with Arboro. Take your 5 or 10% down, go to Arboro, and sorry, the lenders that Arboro uses will in fact use your revenue instead. I've had cases where a couple would qualify for like 300,000 more purchasing power, buying power, versus going through a bank and buying based on their net income.
On their net income.
Beautiful. And then the great thing too is you don't have to really increase your tax amount for 2 years to qualify with a bank, right? Because remember, the higher income on paper, the more tax you have to pay,
Exactly.
right? So for me, it's like if you have 20% down, um, let's get you a better option. And if you don't have it, let's use our borrow and make it happen that way instead.
Which is a great option, especially for
Absolutely.
those that are self-employed.
Hmm. Absolutely.
Okay, I think we've covered most of what we designed to cover. Thank you so much
Oh,
for
Nico,
your
we just,
participation.
Nico, sorry, we just have
Yes,
the new changes to insured mortgages.
yes, right. From
No worries. Yeah, a lot
that
of
took place
information, no worries.
on December
So
15th. I
it's
know.
okay. Yeah, yeah. It's old news now, right? It's been
Well,
already,
no,
yeah, fair enough.
I've pushed it out to all of my database, and so they are aware of it,
Absolutely.
and to
Yeah.
my social channels. Go ahead.
So yeah, big
You can
change
go.
there. It's basically as a first time buyer. Now, if it's a married couple, only one of them has to be a first time buyer. You can now get a 30-year amortization on the mortgage. Before it was 25 years, now it's 30. That really bumps up the buying power and
Right.
also reduces the monthly payment because you're stretching out the payments over 30 years. The other change now is that before on $1 million plus mortgage, million plus, you had to put down 20%, which was
Which is mandatory,
200,000.
right?
Now, $1 million property only needs 75,000 down. A
Okay.
massive reduction. Basically, it's 5% on the first 500,000, and then 10% on the rest, and
Okay.
it's 10% on the rest up to 1.5 million.
Okay.
So before old rules, 1.5 million, you needed 300,000 down. Now it's only 125.
Okay.
So it just gives more access to buyers, helps reduce the monthly payments, helps bump up the purchase price. Just a lot of benefits there for people buying for the first time.
Okay. Excellent. Uh, those changes that took effect on December the 15th were a welcome change, especially for first-time buyers and those that were sitting on the fence for the most part, because of the historically high interest rate environment that we were in for the better part of 2024. So yes, those are welcome changes, and I'm seeing now that a lot of people are inquiring about those changes and getting more active in the market as a result of them.
Yeah, I've seen a massive increase in people wanting to buy now. They're coming off the fence now.
Yes,
With the expected rates to drop. The sentiment's
tomorrow
changing now a little
again.
bit. Yeah, hopefully 1/4%, we'll see. But
Yes,
definitely more, yeah, people are more open now to buying. As we all know, prices have come down a bit from 2021. I'm personally seeing people putting in offers and getting homes at asking or below, obviously depending on the region, of course. But like I said, you know what? It's not easy to buy a home. It does take some planning.
Yes.
But there's programs in place that are there to help. We just have to know that they exist and then work with someone that knows how to use them
How to
and
use them.
use them,
Yes.
right? So
Yes. That's
yeah,
the most
so
important aspect is to get a mortgage
absolutely.
broker involved, a qualified mortgage broker, and get their take on what your options are to present them to you, because that's really what's needed. The banks are
Exactly.
interested in their criteria, their bottom line, but a mortgage broker gives you all of the options that are available.
Exactly. And Nico, another thing to mention too, in my 8 years of doing mortgages, and many times I've seen people who were told that they're pre-approved by their bank, only to find out that they actually were not
We're
qualified for
not.
the mortgage after the fact.
Yes.
Just last week, I got a phone call from a realtor, called me in a panic because her client wanted to buy a home to downsize into. So she has a home that's fully paid off in Toronto, wants to buy a property in Hamilton region,
Hmm.
and she did the right thing. She went to her bank first, bank of many years. Hey, I'd like to buy a property. I can buy it essentially in cash, and then sell my house after. I'd like to get a line of credit to buy the property in full. And then when I'm ready to sell my home, I'll pay off line of credit and be mortgage free. Long story short, they told her she was qualified. She puts
And
an offer in the home, finds
and
out, sorry, we made a mistake. You're not qualified after all. So what happened was, what we did in her case, when I saw her numbers, I knew for a fact she would never qualify for a line of credit through the bank. I don't know what happened there, but someone made a mistake. What we did instead
which
was we got
happens.
her. It happens, yeah, it happens
Yeah,
so
it
often.
happens a lot.
We got her reverse mortgage. I got her paperwork. I got her approval within 24 hours only. It's a
Oh wow.
fully open reverse mortgage, again with no monthly payments. So we're gonna buy the property, it based in cash, and then she can list and sell the home when she's ready to. She can pay off the reverse mortgage penalty free, and there's no monthly payments to carry it as well.
Right.
So just
Which is a
in
huge, huge,
oh,
huge
the relief. She
benefit.
was so happy. She was,
Yeah, I could
Michael, thank you so
imagine.
much. I didn't think this was possible. I thought I was going to lose the house.
Well, of
And,
course, a refusal by the
totally
bank
changed
can be
everything around.
devastating. Yeah, if you don't
Exactly,
know the
right? Because this
options.
was like a dream house for her. Mind you,
Yeah,
she's downsizing, but it's like the right location, the right home she wanted. She can, when she sells her property, she'll have a lot of money left over. She can live very comfortably. But again, she did the right thing, but she got the wrong advice. And that's the
right,
challenge for a lot of people,
right.
right? So what I do is I make sure that when I'm working with someone, I'm properly vetting them upfront, make sure they're fully qualified. And if they're not, we tell them ahead of time, not after you had an offer accepted on the house. That's the
Excellent.
key there, right? So
Yes, yeah.
awesome.
Um, yeah, you are a fundamental resource for those looking to just to make any kind of change in their real estate portfolio. You have a wealth of knowledge and experience. I'm going to include all of your information in the show notes.
Thank you, Nico.
And this episode will obviously be on YouTube and on all the podcast channels. Thank you so much
Awesome. Thank you, Nico.
for your
Appreciate it.
time. That concludes this episode of the podcast, Building Wealth Through Real Estate. My name is Nico James Bach, a broker with Royal LePage Signature in downtown Toronto. My special guest today is Michael Dorego from Northwood Mortgage. Thank you, Michael.
Thanks, much. Bye now.
Ciao.